If you've been watching the markets lately, you've probably noticed something dramatic. Gold and silver surged to historic highs just weeks ago, and then suddenly, they pulled back hard. Billions, even trillions, in market value were wiped out in minutes as traders rushed to lock in profits and volatility spiked across the board. Now most investors look at that and think, it's crashing. Stay away. But experienced investors often think the opposite. When gold and silver rally to extreme highs and then sharply correct, that pullback can create one of the most attractive entry points in the entire cycle. The recent drop wasn't driven by collapsing demand. It was largely driven by profit-taking, crowded positioning, and short-term volatility. The underlying fundamentals that pushed prices up in the first place are still very much intact. Before we go deeper, if you want more market breakdowns like this where we cut through the noise and focus on what actually matters for long-term positioning, make sure you subscribe and follow along. That way you don't miss the next opportunity when sentiment flips again. Now let's talk about why gold and silver still make sense right now. First, understand what these metals represent. Gold, especially, is not just a commodity. It's a monetary asset. It has functioned as a store of value for thousands of years. In modern markets, it serves as a hedge against inflation, currency debasement, and systemic risk. Whenever real interest rates fall or investors lose confidence in fiat currencies, gold tends to benefit. Even after this recent correction, gold remains well above where it was before the rally began. That tells us something important. This is not a long-term collapse. It's a reset within a larger trend. Now look at the macro backdrop. Precious metals are heavily influenced by real interest rates and the strength of the United States dollar. When real yields fall or turn negative, the opportunity cost of holding gold and silver drops. If inflation remains persistent or the Federal Reserve shifts toward easing later this year, that creates a more supportive environment for metals. The structural pressures in the global economy haven't disappeared just because prices pulled back for a few weeks. On top of that, geopolitical uncertainty remains elevated. Whenever there are tensions in global trade, currency instability, or policy mismatches across major economies, capital looks for safety. Gold continues to be one of the primary global safe haven assets. Silver adds another powerful layer to this story. Unlike gold, silver is not purely a hedge. It has a dual identity. It is both a monetary metal and an industrial metal. Silver is critical in electronics, renewable energy infrastructure, solar panels, electric vehicles, and advanced manufacturing. Industrial demand has remained strong, and the silver market has been running structural supply deficits for multiple consecutive years. That means total demand has exceeded total supply. When you combine monetary demand and industrial demand in a constrained supply environment, you get explosive upside potential during bullish cycles. That's why silver tends to move more aggressively than gold. It's also why it tends to fall harder during corrections. The volatility cuts both ways. Some analysts argue that the recent crash may have actually strengthened the bull case. Sharp corrections often flush out speculative excess. When leverage unwinds and weak hands exit, the market becomes healthier. Future advances are more sustainable when they are built on fundamentals rather than pure momentum. Of course, this is not without risk. If real interest rates remain elevated for longer than expected and the dollar strengthens further, metals could stay under pressure. Silver, in particular, can be extremely volatile because it is a smaller and less liquid market than gold. But that's exactly why pullbacks matter. You rarely get the opportunity to buy long-term hedging assets at a discount after they've already demonstrated strong momentum. The recent drop has created that opportunity. For investors looking to diversify, hedge against macro uncertainty, and position for potential policy shifts later in the year, gold and silver deserve serious consideration. The key is allocation, not overexposure. Precious metals should complement income-producing assets and growth investments. They're insurance. And like any insurance, you want to own it before the next wave of instability hits, not after. Right now, we're in that window where fear has temporarily replaced euphoria. Historically, that's when disciplined investors start paying attention. If you understand the macro cycle, the role of real rates, the structural supply issues in silver, and the psychology behind corrections, the recent drop doesn't look like a warning sign. It looks like an opening. If you found this breakdown helpful, share it with someone who's been nervous about the recent pullback. Drop a comment and let me know whether you're leaning more toward gold or silver right now and why. I read every single one. And as always, stay disciplined, stay patient, and focus on positioning before the crowd catches on. I'll see you in the next video.